Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Welcome back to the Week in Review. We've got a classic good news, bad news scenario playing out this week. On one hand, the cost of living is finally dropping as mortgage rates tumble and first home buyers are powering the market while investors sit back. But on the other hand, property values are flatlining, unemployment has hit a decade high, and the Reserve Bank is putting lenders on notice to tighten up their risk systems. So is the market stalling, or is this the perfect window of opportunity before the next cycle kicks off? Today, we're looking at the sluggish start to 2026, finding the bright spots in the unemployment data, and discussing what the RBNZ's new rules mean for your ability to borrow. Let's get into it. Our topics for this week: first up, from Cotality on the 5th of February, 2025 sluggishness carries over into 2026. Topic number 2, from Good Returns on the 4th of February, cost of living dropping as mortgage interest rates tumble. Topic number 3, from New Zealand Advisor on the 4th of February, first home buyers power New Zealand market as investors step back. Topic number 4, from New Zealand Herald on the 4th of Feb, not great but better than it looks. Economists see bright spots in today's unemployment rise. Topic number 5, from New Zealand Advisor on the 4th of February, RBNZ tightens risk rules for New Zealand deposit takers. So first up for this week in review, from Cotality on the 5th of February, 2025 sluggishness carries over into 2026. Property values across New Zealand dipped slightly by 0.1% in January, continuing the flat trend seen at the end of 2025. Cotality New Zealand's latest home value index places the national median value at $802,617, which is 1% lower than a year ago and remained 17.5% below the peak recorded in early 2022. While standalone houses saw a value drop of 0.7% over the past year, townhouses fell 1.7%, and apartments experienced the steepest decline at 4.1%. Trends across the main centres were mixed. Auckland and Wellington experienced declines, while Hamilton and Christchurch remained flat. In contrast, Tauranga and Dunedin posted slight gains. Cotality New Zealand chief property economist Kelvin Davidson described the start to 2026 as muted. He noted that while lower interest rates are aiding borrowers, significant stock levels and lingering concerns over job security are keeping buyers cautious. He added that the upcoming election and recent discussions about earlier official cash rate, or OCR, hikes are also likely to be causing some household anxiety. Regional breakdown. In Auckland, the North Shore proved resilient with a slight value increase, but other areas like Manukau and Auckland City declined. Davidson attributed Auckland City's underperformance to caution around apartments, low migration inflows, and concerns regarding build quality and body corporate costs. Also important to understand that areas like Manukau, for example, there's been a lot of development in those areas, so that could have also caused values to drop because more lower value properties are available for sale. In Wellington, the region remains a soft patch with values down in Porirua and the Hutt Valley. However, first home buyers remain a strong presence, accounting for a record 37% of purchases in the capital in 2025. Invercargill, Gore, Timaru and Ashburton are currently the only parts of the country where values have surpassed previous peaks. Davidson suggested that this is driven by better affordability and a strong farming sector bolstering confidence. Looking ahead, Davidson expects sales activity to rise, but warned that runaway price increases are unlikely due to ample supply and debt-to-income guardrails, or the DTI rules. He concluded that 2026 is shaping up to be another relatively subdued year, with investors closely watching election year policies regarding capital gains tax and interest deductibility. And so my thoughts on this are that all signs point to a continued balanced market, but still favouring buyers until at least after the election. Good opportunities await for those that are prepared to take action when most people sit on the sidelines. Topic number 2, from Good Returns on the 4th of February, cost of living dropping as mortgage interest rates tumble. Stats New Zealand's latest household living costs price indexes, HLPIs, revealed that a 17.3% drop in mortgage interest payments restricted the average household's cost of living increase to just 2.2% last year, which is lower than the 3.1% CPI inflation rate. Unlike the CPI, which measures inflation for the country as a whole and includes new home build costs, which were up by 1.2%, HLPIs track how inflation impacts specific household groups by including interest payments. The data highlights a sharp divide in how different groups experienced inflation. Highest spending households experienced the lowest inflation at just 0.8%, primarily due to an 18.6% fall in mortgage interest costs. This group has a high rate of home ownership, that's 82.3%, and mortgages at 57.2%. Pensioner households, however, face the highest inflation at 3.8%. Since few have mortgages, 8.5% of pensioners have mortgages, to provide interest rate relief, they were hit hardest by rising local authority rates, which increased by 8.8%, and electricity, which increased by 12.1%, and health insurance, which increased by a whopping 20.3%. Stats New Zealand spokesperson Nicola Groden noted that while falling interest rates shielded higher spenders, superannuitants bore the brunt of rate and utility hikes. Meanwhile, rent increases of 1.9% were the primary cost driver for beneficiary and Māori households. Electricity prices were also disproportionately affected lower expenditure households, contributing to nearly a quarter of the annual inflation rate. Topic number 3 from New Zealand Advisor on the 4th of February, first home buyers power the New Zealand market as investors step back. The latest New Zealand Home Loans Property Report by Tony Alexander confirms that first home buyers continue to be the dominant force in the housing market, while investor interest remains subdued. A net 62% of agents reported seeing more first home buyers actively looking, an increase from 56% 2 months ago and 48% this time last year. Alexander noted that even during the economic lows of mid-2025, young buyers remained a strong presence. While market activity appears firm, with a net 55% of agents observing more people at open homes, Alexander described this as a likely seasonal lift rather than the start of a new buyer surge. Price momentum remains modest, with the net percentage of agents sensing price rises dropping from 21% to just 10%. The report highlights a distinct change in buyer concerns. Worries regarding job security and obtaining finance have decisively fallen over summer. Conversely, buyers are newly concerned about interest rates rising again. The number of agents citing interest rates as a key buyer worry jumped significantly from 2% to 27%. The data indicates an investor retreat rather than a resurgence. Only a net 6% of agents see more investors buying, whereas a net 25% report more investors looking to sell. This mirrors the latest Crocker's People and Property Investor Insight survey, which found investor buying intentions at a record low at 16%, while 38% are thinking about selling. Overall, a net 24% of agents believe a buyer's market is currently in place. So my thoughts on the investors retreating is that it is important to understand that we do have an aging population, and a lot of the older property investors could very well be downsizing their portfolio to prepare for retirement, increase their cash flow to help fund retirement. So I think that explains why there's more investors looking at selling than buying at the moment. The other reason that we've got less investors buying is obviously concerns about the upcoming election. But, whenever there's a problem, there's always an opportunity. And this is one of the biggest opportunities that we've seen in over a decade, as long as you're buying the right sort of properties for your financial position. Are you tired of going to property seminars that just want to sell you a house? We do things differently. So join me at one of our free events called How to Succeed with Property Investing. These online events are where we focus on helping you to build the right strategy and learn about the fundamentals of investing. As a financial advisor and an experienced investor, I'll show you how to navigate the current market with confidence and help you to make the right decision for you and your family. We're live, online, and independent, which means we don't sell property. Visit propertyapprentice.co.nz to register for one of our free events and lock in a free spot. If you've already joined one of our events and you're ready to become a lifetime coaching client, you can also book a no-obligation strategy call with my husband, Paul Roberts, via the website. Topic number 4 from New Zealand Herald on the 4th of February. Not great, but better than it looks. Economists see bright spots in today's unemployment rise. Stats New Zealand figures released today today being the 4th of February, reveal that the unemployment rate rose to 5.4% in the December 2025 quarter. It was up from 5.3% previously, so a 0.1% increase. This represents the highest unemployment level that we've had in New Zealand since 2015, with 165,000 New Zealanders now unemployed. However, the data presents a complex picture. While unemployment rose, so did employment. 15,000 more people were in work, marking the first quarterly increase since mid-2024, which is great news for the economy. The simultaneous rise in both figures is due to a growing labour force, with the participation rate increasing to 70.5% as more people, particularly women, entered the market looking for work. ANZ senior economist Miles Workman described the data as better than it looks, suggesting the economic recovery is beginning to positively influence the labour market. Westpac senior economist Michael Gordon stated the results align with the Reserve Bank forecasts. He noted that subdued wage growth means that there's little immediate pressure for the RBNZ to start hiking interest rates. ASB senior economist Mark Smith highlighted that the quarter showed the strongest employment growth in 18 months. Financial markets responded by paring back expectations for rate hikes later this year, causing the New Zealand dollar to drop slightly. Regionally, Auckland's unemployment rate sits at 6.4%, while Wellington's is 5.8%. Finance Minister Nicola Willis pointed to the rise in employment and hours worked as evidence of a growing economy. In contrast, Labour's finance spokesperson, Barbara Edmonds, argued that the decade-high unemployment rate is a direct consequence of the government's economic plan. I think that's an interesting comment made by Labour finance spokesperson, because I would suggest that, with the business owners' increased levels of confidence, that's a good sign that the economic plan is working. So, interesting. Topic number 5 from New Zealand Advisor on the 4th of February, RBNZ tightens risk rules for New Zealand deposit takers. The Reserve Bank, the RBNZ, has called on deposit takers to strengthen their risk systems, demanding more forward-looking practices to withstand a changing economic environment. A recent thematic review covering 9 deposit takers found that while current practices were largely proportionate to the size and complexity of each entity, an uplift in capability is needed to meet the Reserve Bank's expectation. This follows the November 2025 Financial Stability Report, which warned that financial stability risks remain elevated. Kerry Watt, Director of Financial System Assessment, noted that effective risk management is central to protecting financial stability. He emphasised the need for adaptive practices underpinned by strong governance and risk culture to manage both known and emerging risks. The RBNZ expects deposit takers to act on these findings and will monitor their progress. For mortgage advisors and clients, this signals a shift towards more emphasis on documentation, yay, and affordability testing, which should always be a top priority. A closer look at higher risk segments and also a closer look at complex deals, which again should always be a priority. The RBNZ also indicated that its next thematic review will target risk management in the general insurance sector. The data tells us that 2026 is starting slowly, but the underlying currents are shifting. While unemployment is rising and property values are flat, the drop in mortgage rates is providing much needed relief to the cost of living. And the fact that business sentiment is improving means that, and also the fact that we've got more people in employment now than we had previously, this is all good signs of a growing economy. First-time buyers are seizing the opportunities that are available at the moment because interest rates are still low. Yes, there's more chance that we're going to get increases than decreases moving forward from here for the next while, but this is still a great opportunity for buyers. So while investors remain cautious, as we saw in the headlines, think you're missing out on some really good opportunities. If you're waiting for interest rates to drop again, are you crazy? But you can lock in interest rates where they are at the moment for up to 5 years if you want to. So, that reduces your risk. But with the Reserve Bank in New Zealand demanding tighter risk management from banks, lending criteria could get stricter just as the economy tries to recover. Also, if we do enter into higher periods of inflation, where the Reserve Bank increases the official cash rate to fight inflation, that's where banks will also increase their risk management by tightening lending criteria. So, all of this means that if you wait for too much longer, you might find that you're not going to be able to borrow as much as you can at the moment. So I think this window of opportunity is here, potentially for the rest of this year, but the window is closing. If you're trying to navigate these mixed signals, wondering if you should buy now while competition's low or wait for more certainty, you need a plan, not a guess. So start your process by attending one of our free online masterclasses called How to Succeed with Property Investing. Remember, we don't sell property, so there's no conflict of interest there. We're not just going to try and flog you a dodgy deal or something that doesn't fit your personal financial situation. These events are all held live and online, so you can ask me as many questions as you want, and I will answer as many as I possibly can. It'll help you gain valuable insights and strategies tailored to today's market conditions, regardless of where you live. Whether you're an experienced investor or just starting out, this free session will help you with some key tools and insights to make a more confident, informed decision. Don't miss out. Register today and take the next step towards achieving your financial success. Obviously, if you're already a client of ours, you can reach out to your coaches anytime you've got questions or need help with something. At the end of our free events, I'll tell you more about how we could help you as a client to achieve your investing goals. So if you're interested in finding out more about how we can help you, go to propertyapprentice.co.nz and register today. If you've already been to one and you'd like to know more about how we can help you on your journey or whether or not we're a good fit for you, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.